Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Charter Market Technician and Portfolio Manager. Thank you so much for joining us and giving us a little bit of your time. We got a couple of topics for you this week. We're going to talk about a potential recovering in manufacturing activity, and then we're going to take a look at profit growth from some of those mega cap names. So let's jump right in to manufacturing activity. So we got a slide to throw up, and what we're looking at is two lines, and this is from the ISM report that we get from the first of each and every month. And within that, there's two indicators. There's one showing you the level of real activity, and it's either going to be above 50, which signals an expansion in the economy, or it's below 50, showing deceleration. And that is that darker blue line. The gray line indicates new orders. So it's more of a leading indicator and forward looking to what the actual activity may become. And so the good news here is that even though manufacturing activity has been sluggish, so the economy kind of hit the skids a little bit in 2022, kind of teetered and flirted with a possible recession. Of course, we bounced back, but that bounce back came much more from government and consumer spending and services than it did from manufacturing, which has stayed sluggish. But over the past several quarters, what we've seen is a solid and healthy rebound in new orders. And here recently, they have been exceeding inventory levels, meaning that there's potential inventory drawdown that needs replenished. So the outlook here is actually pretty healthy for a manufacturing recovery, which would be good to kind of help supplement and help pick up the other pieces of growth, even if they were to slow down a little bit on the services and government side, which they very well could. So this tailwind would be a nice one. We have seen a nice string of GDP quarters that have been well above 2 and often near or above 3%. So even though we've kind of backpedaled just a little bit as we ended 2024, this sure would be nice to have us kicked up and maybe back into the 3% range. So that's the economic stuff. Andrew's going to take a look at the profit growth of those Magnificent Seven companies.
Thank you, Adam. So one of the topics we often cover on these market covers every couple of weeks has been the Mag 7, those 7 mega cap stocks that you're probably all familiar with the names: Apple, Microsoft, Google, a big one being NVIDIA, a semiconductor company. And these are the stocks that make up some of the largest shares of several sectors as well as the overall market. And because we talk about them so often, the reason being is what these stocks do over the last couple of years has really been driving what the market does. You could call it the massive tail that's wagging the dog. And so now as we start getting deeper into earnings season, we want to really evaluate and see how are these mammoth companies doing on their earnings front as they start reporting what happened at the end of last year. And so this chart from Bloomberg shows that we are seeing a deceleration of growth from the profit for these 7 stocks. And well, yes, it's only 7 stocks, but they do make up a very large part of the market. And so while they continue to grow, you can see there that since Q3 of 2023 in Q4, they've begun to slowly have slower growth. Now, it doesn't mean that they're not growing at all. It's just that they're not growing at the same speed, the same velocity that they were over the last couple of years. And so we are seeing over the last for Q4, many of these companies did meet expectations. They didn't necessarily have these massive beats that we've grown accustomed to. And we still have one company left to report, NVIDIA, which is always kind of a laggard. They always report a little bit late in the season. But we're continuing to really focus and monitor what these companies are doing because it can have rippling effects to the rest of the tech space, consumer discretionary stocks, and all the other stocks that really kind of are attached to these 7 names and feed off of them for growth and for the importance that they have in their sectors. And so as we're starting to see growth decelerate, we are looking at then how are these companies guiding going forward? Are they continuing to have bright future expectations? And that's often what the market keys on. We're not seeing major market moves outside of maybe single day events based off this deceleration growth. So the market's taking it pretty well in stride, but it's something that long term, if these trends continue to begin to slow their growth, then we will begin to start seeing the market potentially need to reevaluate what type of growth multiples they're putting. And if we're going to continue to see the same type of growth going forward and the trend we'll see in price as a result of that over the next coming years. So again, this isn't a short-term story. It doesn't matter just over the next couple of weeks, but it's something we're looking longer term, quarters, months, and years out as these trends become important in those types of time frames.
Andrew, so thank you for that, and thank you to all of you for giving us your time for this week's Market Carver. As always, if we can be of help, please don't hesitate to reach out. 800-928-4001 via phone, or scan the QR code and do so electronically. Thanks again and have a great weekend.